And we are back to another week of market action, but it's not like anybody would have noticed because things are relatively quiet here as we get started on this week. Obviously, an explosive one last week with a whole bunch of movement centered around that CPI report out of the US. And another week ahead now asking questions about whether we are going to muster follow through. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And what we're going to do here is take a look at what are some of those macro catalysts that are going to present themselves in the week ahead. And of course, the main question that we are going to be asking ourselves is, now that CPI is out of the way, now that a lot of the other event risk is out of the way, is the market basically out of bad news? Or at least the capacity for bad news? With so much that's already come out and with a relatively quiet week on the economic calendar, what really is there to dissuade these markets from a kind of broadly optimistic disposition that they very clearly signaled in the wake of CPI last week? So let's begin with a look at how this performance looked last week and sort of how we got there. Not surprisingly, we can see here stocks up again, albeit not quite as vigorously when it comes to the S&P, and more vigorously when it comes to the tech-heavy NASDAQ. It rose over 2%, S&P up 1.5%. Also, not surprisingly, the story for bonds was developing in tandem. Bonds up, and we can see here yields down, 10-year down 1.7%, 2-year down almost a full percentage point. And all of that, of course, coming in the wake of that CPI report. That was the big center of gravity for investors with a macro lens last week. It essentially signaled that disinflation has resumed. So for 2 months, the Fed was looking at inflation numbers that were registering hotter than expected, and the actual process of disinflating was arrested. And so the markets were looking at this, as were Fed policymakers, and saying, hang on a minute now, is there still scope to cut rates? Maybe there needs to be the resumption of rate hikes. After all, that of course was a source of worry. And so when we got that inflation data, and not only did it give us the lowest core inflation in 3 years at 3.6% growth year on year, but more importantly, it resumed the progress that the Fed has been constantly saying would be resumed with time. So the markets clearly liked that. And we ended up returning to record highs, or indeed setting them for equity indices. We ended up seeing strong gains for bond markets as yields came in. Not as robust as stocks, but they certainly responded. Gold led the sort of tone in metals, although copper and silver had the bigger gains. Gold rose another nearly 2%. The dollar got clobbered against most of its major counterparts. We can see here the sort of avatar for that. The euro rose 0.9% against the dollar. The yen stood its ground after a 2% loss last week, as maybe the most sort of loud exclamation point on robust risk sentiment. The Bitcoin ETF surged double digits and added over 10%. So we're looking at a situation here, seemingly, that is unmistakably supportive, and the sort of main kind of driver here, clearly those CPI numbers that relieved the markets of their concerns and set the stage. Now, what's particularly interesting this week is there's not a whole lot on the calendar that is going to immediately challenge this dynamic until we get to Wednesday. And here we are going to get minutes from the Fed's May meeting. And what sort of sets the stage for this is perhaps the realization that we've seen a sort of anchoring in Fed policy expectations that seems to have given the green light to stocks to recover. And we are once again reminded that it isn't so much a particular setting, although that's, of course, important. It is the direction of travel. So we can see here, just really quickly summarizing the arc of this narrative going back to the fourth quarter of last year, when the Fed signals late October, early November, and indeed at the November 1st policy meeting, that it is almost certainly done raising rates and the next step is probably lower, the markets start to speculate what lower means and build out as many as 6 rate cuts into the outlook. Stocks, of course, love this. They start to rally. As we get into the latter parts of December, the Fed actually defines what it means when it says cuts and gives a forecast of 3 cuts or 75 basis points in easing for 2024. The markets kind of center on this. You can see that as this becomes anchored, so too do the moves in the S&P. So we can see sentiment here basically stalls as we get ready for the Fed to define what cuts mean. They do, and it's relatively late into the year, so nothing actually happens until we begin 2024. And here, the relative spread starts to matter, where the markets say the Fed is going to have to do this many cuts, and the Fed says we're going to have to do this many. That, of course, makes the markets much more dovish than the Fed. And so the markets begin to gravitate higher on this idea that invariably the Fed is going to have to come the market's way on this. Of course, if the markets didn't think that, they wouldn't be priced the way they were. And so you have this dovish policy tailwind, but U.S. economic data starts getting better, so the stock of cuts begins to diminish. And diminish and diminish and diminish until the point where it equalizes with that of the Fed, and speculation is short-circuited. Stocks stop rallying exactly at that spot. As this continues to diminish, stocks correct lower until we get to a new sort of a plateau. And once we really anchor at this level, latest Fed policy announcement and CPI data notwithstanding, stocks find their way higher again. Because it appears to be that now the markets have kind of settled on about a cut and a half. What we find now at 33 basis points is one full cut. That's a 25 basis point cut, and anywhere between 40 and 50% likelihood of a second cut, depending on which day you look. Because sometimes you're at 36 basis points, 32 basis points, 31, 35. So we're sort of jostling around this area right here, but the general idea that we're at one cut and about a coin's toss chance, 50-50 of a second, is where things have kind of anchored. Minutes from the May Fed meeting come out this week on Wednesday. And that becomes the first time that the markets really have any kind of a test of this baseline idea, which they seem comfortable with. That stocks have resumed rallying suggests 1.5 cuts is perfectly fine as far as investors are concerned. That is okay, especially since expectations for 2025 have been getting increasingly dovish. So it appears as though the markets are just pushing the cuts back. But that we're going to get 1.5 this year seems to be acceptable enough that stocks can rise on it. So what these FOMC minutes are going to tell us, perhaps, is just how willing Fed officials were, or just how concerned they sounded as it pertained to resuming rate hikes. Would it be a situation here where you would have something like a view that we would have a significant, let's say, constituency on the FOMC to resume rate hikes, and it was something that was on the line as close to being signaled? Or would it be something that's, as Fed Chair Powell made it seem in the press conference after, something that was relatively distant, something that the Fed didn't think was a live risk, as it were? And so this is perhaps the only kind of meaningful bit that is going to drive this narrative this week. It'll be an interesting one because, of course, the Fed understands very well that it releases massaged minutes. It doesn't release a point-by-point verbatim account of what went down. It's an editorialized summary. And the Fed understands that this is guidance. So it'll be interesting to see what it is that the Fed signals here. If it appears that they were readier to put hikes back on the table, then perhaps Fed Chair Powell seemed to suggest when he spoke after the meeting, that might give the markets a bit of a wobble. But if it's all clear, then we're back to square one. On the same day, we are going to get UK CPI data, which is going to give us a sense of how other central banks are thinking about this. And the expectation here is that UK inflation is going to drop significantly from over 3% to 2.1% year on year. That would be consistent with the broadening of disinflation that we've seen. We can look at the components here and see that really the big standouts, energy, which was the big story in 2022, is now a drag. It's actually a negative influence on inflation. Food, which was a big story in 2023, has come in significantly and has fallen away as a major defining catalyst. In fact, if we look at the roughly 7-month lag between global food costs and when they show up in CPI, there's more of this disinflation to go, it seems. The big remaining pockets seem to be discretionary spending. And here you might expect that with the slowdown of the economy, and the UK economy is not exactly falling apart here, it's growing at a reasonable rate, but relative to history, it is not exactly a picture of strength. It has recently emerged from, depending on how you define it, recessionary or near recessionary conditions. So what we're looking at here is sort of the eventual catching up of that economic weakness to staffing levels, to discretionary spending levels that invariably disinflate things like hospitality and recreation. And so the pathway in the direction of rate cuts seems to be relatively well established here. With that in mind, we, of course, go back to what the Bank of England told us just 2 weeks ago, a little bit less even, where they essentially set the stage for easing and said, look, we know that the expectations for policy adjustments have actually shifted into a less dovish direction, but we don't see things that way. We actually see as likely that we are going to have to ease relatively soon, and we want to set the stage for that. In fact, the voting pattern on the MPC, the decision body at the Bank of England, became very pointedly more dovish as more policymakers, now 2 out of 9 rather than 1, started to vote for cuts. So what we see here is at this point a situation where the markets are pricing in 55 basis points in easing from the Bank of England this year. That amounts to 2 cuts and about a 20% chance for a third. Now, we can see that this has diminished since the beginning of the year. But as we've talked about before here on Macro Money, that largely reflects this same thing happening in the US because of the gravitational pull of what the Fed is going to do on global rates. The Bank of International Settlements very pointedly shows that nearly 90% of global monetary transactions are settled in dollars, which means that as borrowing costs and expectations for borrowing costs of dollars change, that changes the expectation and the pathway for global borrowing costs anywhere and in any currency. And so just as we've seen the outlook for the Fed become less dovish, that has pulled in other central banks' expectations because it's impacted credit instruments and interest rate instruments the world over. We've seen some pushback on this kind of thing from the relevant central banks, from the Bank of England, from the ECB, from the RBA. And so, although we can see here that there's been a narrow hawkish adjustment in the policy path, we can see here the big dotted line is where the Bank of England curve looked like when they last met in March. The small dots are where it was when they just met in early May, and this is the current curve in the solid line. And we can see that not a big difference, of course, here between May 9th and now, but a little bit of a hawkish adjustment between March 21st and now. And that's arguably more having to do with the knock-on effects from what's happened in the U.S. Interest rate markets relative to what the expectations of the Fed have been doing rather than anything in the UK. And what we see here is the first cut is expected in August, and the second one appears by December. Now, if this CPI data is going to create a situation with its rapid disinflation tendency here, if this is going to create the kind of situation where it looks like maybe cuts are going to come sooner, on the same day that we get FOMC minutes that show us a level of reluctance at the Fed to rush one way or another and to kind of sit still, you might get a widening of yield differentials in the dollar's favor. In which case, you could see some downside for the British pound, some upside for the US dollar. But that's, of course, if this data is going to go that way, because the expectations already are for a move down to 2.1%, which is a mere 0.1% away from the Bank of England target. So the risk seems to actually be tilted the other way. The expectations are already very low. So the risk is actually that this is going to surprise higher and that the spread between the dollar and the pound vis-a-vis interest rate expectations is going to narrow against the dollar, and that the pound might actually have a bit of upside in it despite inflation coming in, because in relative terms, the more impactful thing, the thing where people are less well positioned and would need to readjust, would be on a Bank of England that is going to broadly behave as expected, maybe even with a little bit less vigor as opposed to the other way around. And finally, the last bit rounding out the macro calendar for the week is the May set of PMI numbers. This is a proxy for economic growth across a variety of major economies. And the thing to really watch here more than anything are these composite numbers. Now, what we find is that the expectations are relatively benign. So if we look at the Eurozone first, we can see that we're expected to go from 51.7 to 52. A bit of an acceleration, not much, relatively steady. For the UK, here's the composite number again, from 54.1 to 54. A little bit softer, but again, growth. And growth at a pace that's relatively even-handed. As ever, above 50 is growth, below 50 is contraction on PMIs. For the US, to kind of put the exclamation point on it. Although we don't have official forecasts for the composite figure, we can see steady on manufacturing, steady on services. And so we're looking at a situation where the U.S. economy, on the whole, is expected to broadly hold unchanged. And once you do the scaling, you can see that for the composite, that would shake out to 51.4 on the composite number, which would be steady from April. And what's interesting here is it would essentially line up with the period that inflation has stopped disinflating. We can see here was the big period here where inflation was starting to come down. It has since anchored because economic growth has basically anchored. There was a bit of an upswing at the start of the year here into the first quarter that has since crested, and we've since receded back. May is looking like it's going to keep that in place, but nothing particularly controversial expected here. Until you look at the way U.S. economic data and indeed global economic data has been performing relative to forecasts. Data from Citigroup suggests we are quickly unraveling on U.S. economic data relative to forecast, and that is starting to pull global averages with it, which of course raises a question about global recession and says, this is how this is different from the first quarter. In the first quarter, we had the prospect of a more dovish Fed, or at least some amount of rate cuts, even though it was diminishing, in excess of what the Fed was thinking. And the economy appeared to be at least somewhat on an accelerating path. Here, you are very pointedly not seeing that. And if these numbers shock on the downside, as we have seen from US data recently, and this echoes into the global numbers, well, then the question about stock market's ability to keep going is going to be less so about what the Fed does with that the 1.5 cut that's already there, and more about, does it actually need to do more? And were they right the whole time to be calling for 3 because the business cycle is turning, which of course would not be the kind of rate hikes that the markets might want to celebrate. And that is the macro week ahead. As ever, we are here with this show every Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow. I'm back on with Chris for Futures Power Hour on Fridays. on with Victor Jones for his new show, The Price of Truth, on Wednesdays. Back on with Victor and Tom for First Call on Sundays. Writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow. See you then.